more than 18,000 people in California lost access to at least $28 million they believed was safely sitting in a Yotta account. Yotta had told them the money was FDIC insured, safe even if Yotta itself disappeared. But before moving those accounts into the system that later froze them, Yotta's own leadership privately warned that it did not trust the company running that system. Then the accounts froze, and the event FDIC insurance is designed for had never happened. No insured bank had failed. To an ordinary customer, FDIC insured means one thing. However this company runs its business, my money is safe. That's not a naive assumption. It's the assumption the phrase is designed to produce. For nearly a century, those letters have meant that when a bank fails, the FDIC protects insured deposits up to the applicable legal limits. One technical disclosure noted that funds moved into the brokerage account might not qualify for FDIC coverage, but Yotta's broader message reassured customers this was only a back-end change that kept their money at insured banks and increased their protection. California regulators later found that overall marketing deceptive. Yotta's overall message did not make clear how differently those layers could fail, or why the distinction between them could determine whether customers could access their money. It only mattered once something went wrong inside a part of the system they never knew existed. Here's the structure that sat behind that single number on the screen. The company customers saw was Yotta. Yotta didn't hold the money itself. It wasn't a bank, and it never claimed to be. Behind Yotta sat a second company, Synapse, whose job was to keep the ledger, the record of which customers' money was sitting where and how much of it belonged to whom. And behind Synapse sat the actual banks, FDIC insured institutions holding the real cash in pooled accounts, built to serve thousands of customers from several different apps at once. 3 layers: the company you saw, the company keeping the books, and the bank holding the money. Only the bank in that chain was ever insured by the FDIC, not the app, and not the company keeping the ledger. For years, that arrangement appeared to work from the customer's perspective. Most customers never learned any of these companies existed. They opened an app, saw a balance, and assumed that number was simply what their bank showed them. It wasn't. It was a balance generated from Synapse's records, a ledger customers could not independently inspect, and the partner banks still had to reconcile against their own books. In October 2023, Yotta shifted customers into a brokerage-based cash management structure operated through Synapse Brokerage. FDIC-insured partner banks remained in the wider chain, but the legal and operational path between the customer and those banks changed. Under that program, customers were placed into brokerage accounts, while their cash was swept into pooled accounts at FDIC-insured partner banks. California's own order is direct about the result. Once Synapse collapsed, FDIC insurance was not available to cover the losses these customers experienced. That's not the same as saying the insurance never existed. It means something more specific and more important to understand. An insured bank holding underlying funds is not the same thing as a non-bank company operating the records on top of those funds. Neither is the same thing as a customer's ability to access their money on demand. And none of those 3 things is the same as having a verified paper trail proving exactly which dollars belong to which customer. Those private concerns were not part of the reassurance customers received. On April 22, 2024, Synapse filed for bankruptcy. Within weeks, customer accounts across a dozen apps, not just Yotta, froze. The reason wasn't complicated to describe, even if it was hard to fix. The balance inside the Yotta app came from Synapse's own ledger. The banks holding the actual cash kept their own separate records. When those 2 sets of numbers were compared, they didn't match. That mismatch is the entire crisis in miniature. It doesn't mean every dollar customers believed they had was gone. It means the parties could not establish one reconciled set of customer balances. banks handed a request to pay out money, don't simply trust a screenshot from someone else's app. They need their own confirmed records. Those records, for a significant share of accounts, no longer lined up with what customers had been shown all along. In its 2025 complaint, the CFPB cited the bankruptcy trustee's estimate. The shortfall was somewhere between $60 million and $90 million. Over time, the partner banks distributed substantial amounts back to customers, but many customers still did not receive their full displayed balances. As of September 2025, thousands of California customers still had not recovered their complete Yotta balances. That gap is measured in tens of millions of dollars, not pocket change lost between systems. What caused that specific gap and where that money actually went was never conclusively established. The bankruptcy trustee overseeing the case, a role that exists specifically to trace this kind of financial trail, said plainly that the source of the shortfall could not be determined with the information available. The public record does not establish theft or a final destination for the shortfall. It establishes that the shortfall remained unresolved. This is the part that resolves the paradox from the beginning of the story. Federal deposit insurance isn't a general guarantee against every delay or dispute over money in the financial system. It is triggered by one specific event: an FDIC insured bank failing. The FDIC protects insured deposits up to the applicable legal limits when that happens. Only after a bank fails does the FDIC determine ownership and coverage, and pass-through protection for pooled accounts depends on accurate ownership records. None of the banks holding Synapse's customer funds failed, not one. Synapse itself was never an FDIC-insured bank. It was a technology company, and its bankruptcy is a different legal event from a bank failure. Because no insured bank failed, the ordinary FDIC resolution process was never triggered. What actually happened sits one layer upstream. The bank held a real pool of cash. The app showed each customer an individual balance. Synapse was supposed to maintain the map connecting one to the other, proof of exactly whose money inside that shared pool belonged to whom. When that map stopped lining up with the pool, the banks could no longer treat every number on every customer's screen as an already verified claim. That is the kind of record-keeping failure described in the CFPB case, not a failed bank event, and not the event federal deposit insurance was built to answer. Responsibility for what went wrong is split across several separate findings. California regulators found that Yotta's marketing was deceptive. The Consumer Financial Protection Bureau alleged that Synapse's inadequate record-keeping was an unfair practice that harmed consumers directly, a case that ended in a stipulated final judgment, not a criminal conviction. Separately, Yotta has accused Evolve, one of the partner banks, of misconduct in a lawsuit Evolve disputes, and that remains unresolved. That accusation is an allegation, not a finding. And the bankruptcy trustee, whose job was specifically to trace where the shortfall came from, said the source of it could not be determined. These were separate proceedings addressing separate conduct, not four parts of one unified verdict. None conclusively established where the remaining shortfall went. In September 2024, the FDIC proposed a fix aimed directly at the kind of gap this collapse exposed. Banks covered by the proposal would have to maintain beneficial owner records themselves or have direct, continuous access to records maintained by a third party and reconcile those records regularly, even if the company managing them collapses. In practice, that means an outside company's ledger could no longer stand alone as the only record of who owns what. The proposal responds directly to gaps regulators observed in cases like this one, where no single set of records could establish who owned what once the pool and the map fell out of sync. The official sources reviewed for this production still identify the measure as a proposed rule. No finalized version was confirmed. So return to that original promise. FDIC insured, completely safe, protected no matter what. Part of that promise was true. The banks at the bottom of this chain really were insured. If one of them had failed, the FDIC would have protected those deposits up to the applicable legal limits, the way it has since the 1930s. But the promise Yotta actually sold customers was bigger than that. Protection against everything, including the collapse of a company most customers never even knew existed. That promise was never something FDIC insurance covered, and no marketing claim can retroactively make it true. The insurance was real. It covered a bank failure that never happened. What it did not cover was the collapse of the system standing between the customer and the bank.